Hey, badass business owners, let me ask you a question. Is there an easy way for you to know exactly how much your business is worth at this moment? Like if you shut the doors down, would you know how much money your business would end up paying you? Like what's its value? Could you tell really quickly off the top of your head how much you owe other people? How much you would walk away with? Believe it or not, there is a tool in your tool belt that will tell you this information at any given time. It is something at your fingertips, and the odds are you probably haven't even ever looked at it. Now, don't get me wrong, there are some of you that have looked at it, but you're probably confused by what the heck this even is. Now, what I want to do is I want to take a few minutes and I want to kind of tell you a little bit about this tool. And as a matter of fact, I recently did a video of it on the YouTube channel where I broke it down and showed you how to do it. So I'll talk about that more here in a moment, but just know that there will be a link in the show notes if you want to watch that video. So what on earth is this powerful tool in your tool belt? It is your business's balance sheet. It is a piece of paper. Usually it's only one page. Sometimes it'll bleed into two, depending upon how many assets you have in your business. But what it does is it summarizes all of the items that are assets, things that you own that have value. Then it's going to have a section on there of all the liabilities where you owe other people money. And then finally, it's going to have a section that has the owner's equity, meaning you as the business owner, what money you have available to you at the end of the day. If you think about it, your net worth personally is what you own minus what you owe. That's what's considered your net worth. Well, your business also has a net worth, and it's going to be the assets of your business minus the liabilities, what you owe, and that's going to be what is the business's net worth, which ultimately goes down to the business owners. Now, if there's more than one of you in that business, just know that owner's equity will be divided out between all of the owners. So it's really the business's value, and then how that's divvied up will be based off of how that company is put together. But the main thing we want to do is understand what this report is telling us. So this way, when you get it, you can look at it. So let's go right back to the beginning for a second. You usually will get this every single month as part of your important documents that your bookkeeper, CPA, whoever does your books do. So when you print your profit and loss, typically if you go to a CPA or somebody and they give you a packet or they email it to you or they have a box where you go online and get it, inside of there is going to be not only your profit and loss statement, but you'll notice that it also will have sometimes the detail of everything that you spent, but there's also this page in there that says balance sheet. And more than likely, you probably just zipped on by it because it just looked like a bunch of numbers on a page that didn't make any sense to you. And you're like, okay, whatever. For those of you that have seen it and have attempted to understand it, more than likely it went something like this. There's a lot of numbers on here. I don't get why they call it a balance sheet. I don't see anything matching something else. My assets equal one number, but yet my liabilities are a different number. My owner's equity is a different number. I don't understand this whole balancing thing. And it gets confusing, therefore you never looked at it again, or maybe you attempt it once a month and you're still confused as to what it is. So what we're going to do is I'm going to try to explain this in the podcast. Now, earlier I mentioned that I recently did a video on this, and here's why. Obviously, doing podcasts, it's very difficult for you to get a visual idea of numbers. I'm going to do my best on this episode, but if you want to be able to do this visually, just make sure you hit that link below. Go watch that video. It's going to help you out. Now, the reason that is called a balance sheet is basically all of the assets, everything that the business's value is, right? Because that's what we think of as the value of the business, is everything that it owns, everything that it has. Now, what a balance sheet will not tell you is what somebody's willing to pay for the business. Because when someone buys a business, they're buying the future of what that business can create. But the moment in time, the minimum of what a business is worth, the minimum is always going to be the assets the business has minus its liabilities. Okay, what it owes. That's going to be the minimum of what it's worth. Now, in this particular case, the reason we have owner's equity is because that's ultimately the value of what's left over for the business owner. Hopefully that makes some sense to you. So when we're looking at the three sections, what is balancing is this. Everything that the business owns, remember I was talking about assets, that's everything the business has. At the end of the day, when you close the doors, those assets would be theoretically sold and then given to other individuals. So the first part of the money to come off at the top is going to go to what is owed. It's going to go to any liabilities that the business has. Then any money that's left over would go to the owners. So for example, let's use a small number. Let's just say the assets of a business is $1, but that business owns 30 cents to a bank or to a lender or to vendors that they owe money to. In which case, the 30 cents come right off of the dollar and those go to liabilities. Then the owner would get the remaining 70 cents. So if you think about it, if you take the 30 cents that is owed plus the 70 cents that is owed to the owner, it also equals $1. Therefore, it balances. The assets were worth $1. The liabilities and the owner's equity also equal $1. Therefore, they balance. Now that makes it way easier to understand why it's called a balance sheet. Basically, the assets go to one of two places, either to the people that the business owes money to, or it's going to go to the owners of the business or to pay back the owners of the business. Make sense? Really simple now that we understand what the balancing part comes in. Now, what may not be as easy to understand is what goes in each of those categories. So let's take a closer look at each one of those. When we're thinking about our assets, we have all different types of assets. The most common asset is going to be cash. When you run your business, you take in money, right? Your revenue. Then you go out and you pay your cost of goods and your expenses, right? Say it with me. Sales minus cost of goods minus expenses equals profits. So at the end of the day, with those profits, you're doing different things with them, right? In most cases, you're going to you're going to pay the owner some of it, which will end up showing up later, which we'll talk about, but you're going to put some of that in a bank account. You're going to pay taxes more than likely. Now we have our retained earnings, right? So let's just say we're putting that money in the bank. Now, when you start putting it in the bank, you start creating assets. It is cash that the business has. For some of you, you might have one bank account. Some of you who follow profit first and you break out all of your different accounts, you might have 6 or 7 accounts. You might have some savings accounts. You might have some checking accounts. It doesn't matter. Whatever accounts that you have that have cash in it that belong to the business, those are going to be under your assets. So for example, if you have an operating account, you're going to have the cash that's in that. If you have a tax account holding money, it's going to be in that because these are taxes you haven't paid yet. Okay, those will show up later as a liability, but for right now, it's still cash that the company has in hand, so it is considered an asset. Other assets that the company might have would be any type of tools, equipment, trucks, things that the business owns. They've gone out, they've purchased this, so these are assets. Now, what will throw a lot of people off is under your assets, typically they remain at the purchase price that you did it. So if you went out and you purchased a vehicle for say $70,000, then it confuses people because it's 2-3 years down the road and it's still showing on the assets as $70,000, even though we know that trucks, cars, vehicles depreciate and they go down. In which case, you should see a depreciation line also under your assets, which are a negative number, which would pull that number down. And typically that is because when you're doing your taxes, they'll actually take that off. Some of you will see that, some of you won't. It depends upon how yours is set up. Yours may have that vehicle at its current value versus its reduced. And that's sometimes where it can get confusing because there's going to be a couple places where I talk about on your balance sheet where the numbers are combined into one number. So instead of saying 70 and then depreciation of 30, it might just have one line that says 40. Same thing later under owner's equity, which we'll get to. But basically, it's going to be all the assets. It could be if you own a warehouse, that would be an asset. If you rent it, that's different. But let's just say you own the warehouse. Maybe you bought some land for the business. Basically, anything that the business has purchased that it can turn around and sell, that's going to go under your asset section. Another thing that's going to be in your assets is any money that is owed to you. So for example, you might have done some work and you're waiting for payment on that. Those are accounts receivable, right? They're money that you're going to be getting into your business. So in which case, that is also money owed, and it's going to be considered an asset because the business should be collecting that money. Sometimes on your assets, it's going to be broken down into two sections. The first section is going to be current money, money that's hot in your hands. So that's going to be your bank accounts, money that is owed to you relatively soon, stuff like that. Whereas your long-term assets are typically going to be that property, equipment, tools, things that you can't just turn around and convert into cash. You have to actually go do something to convert it. They're more long-term. So sometimes when you're looking at your assets, you might see two sections, which also can make it confusing. But just know it just means short-term versus longer term. But at the end of the day, everything that the business owns or has cash or can convert to cash is going to be sitting under that asset section of your balance sheet. Now that's going to be the total, right? So that's our $1 from our example earlier. Section 2 is your liabilities, and your liabilities is going to be any money that the business owes at this time. So you might have loans that are outstanding. You might have vendors that you owe. Now there's going to be two categories on there that might throw you off. I think it's like 3 or 4 actually when you start diving into it. But let's just say you have employees and your employees have worked 4 days so far, but payday hasn't shown up yet, but it's still money you owe those employees. So on your balance sheet, you're going to have a liability on there for payroll for money that has not been paid yet. Because at the end of the day, if you were to close down the business tomorrow, you still owe those employees for the time they've already worked. So you'll always have a number on there for money that is owed to your employees because it's their final paychecks, if you will, if you were to close the business. Same thing when we collect taxes that we owe, those are going to be a line that's on there as well. If you have vendors that have done work and you pay them like 30 days later, that's going to be on there. So think of your liabilities as any outstanding loans, credit card balances, basically any money that the business owns. You also might find this broken into two sections of short-term and long-term as well, because it's money that needs to be paid immediately or sometime in the near future versus longer-term loans that are over a few years. Those will be in a second section. But if you think about your liabilities, it's just money that is owed to somebody. So sometimes what screws you up is when you're looking on there is you're trying to figure out why these payroll items are on there, these taxes, these different things. It's just money that you know for sure has to be paid. Your accounts payable will be on there, and sometimes you'll see that line, and that's just money that, like I said, you've already collected the money or you owe the money. So on your assets will be the money that is people owe you, and your liabilities will have any money that you're already owing other individuals. That's what your liabilities are. Now, your owner's equity is going to be basically catching everything else, because as we did in our example earlier, right, our dollar was our assets, our 30 cents is our liabilities, what we owed others, and therefore to balance, everything else goes under owner's equity. Now, your owner's equity is going to come from a few different places. When you started your business, you might have put money into your business. So you might have an owner's contribution that's on there. That's the original money that you invested in the business. So when you started, you had to put out $1,000 to buy equipment, say, or you started with $5,000 or whatever the case may be. There's going to be an owner's contribution. And you may have had to put in some money a couple times in the very beginning to get the business going, and maybe that added up to $10,000, whatever the case may be. More than likely, there's probably a line on there for the money that you initially invested in your business. But for most people, what happens is you use retained earnings to grow the business. So there's going to be some other lines on there. Now, before I go much further, let me tell you why sometimes it can get confusing when you're watching other videos on this or you're going online to learn about owner's equity. When you think about owner's equity, a balance sheet is in every business, small or large. Well, when you get into these big Fortune 500 companies, they have shares, right? They have shareholders. The owners don't just own the business. The people who have bought stock in the business own the business. There's going to be a bunch of lines on a balance sheet that have nothing to do with your size business, because more than likely you don't have stockholders. Now, I'm not saying that's all of you. There's probably one or two of you that may have set yours up this way if you have a bunch of partners in your business. But for the vast majority of people that listen to my show, that's not what you have. So don't get confused by certain categories on there that will never impact you in your small business, okay? You don't have large sums of amount of money that is going to be paid out to multiple different people. So you're not going to have those lines. So in most cases, you're going to have it boiled down to just a few lines, one of which was that owner's contribution, which is the money that you put in that we talked about earlier. Then what's going to happen is you're going to have the money, the profits that the company made. Now, here's where it can get confusing for some of you, depending upon how yours is set up. Remember, we talk about sales minus cost of goods minus expenses equals net profit, right? So that's going to equal your profit. What happens is for most businesses, you take in a profit, and then from that profit, you have been taking an owner's draw. You've been pulling money out from those profits. Your balance sheet may have this done a couple of different ways. There are some people that have it set up to where it's the difference. So let's say you've been in business for a year, and in the course of that year, your profits have been $30,000. So you may have a line on there that says profits, but it's going to basically refer to the net income that the business took in. So it might have a line that says net income of this $30,000, but then it's going to have an owner's draw of, say, $20,000. That means that you pulled out $20,000. So it'll be a negative number, basically letting you know the owner is owed $30,000, but they've already taken out $20,000. Now, for some of you, there'll just be one line that will be owner's equity, and it might just say the $10,000. It just depends upon how yours is set up. I have seen it both ways. But at the end of the day, it's going to be able to give you what the business has taken in as profit and then taken out what you as the owner have already taken out of the business. And that's going to give you your owner's equity. Now, once again, if we go back, your balance sheet is your assets should equal your liability plus your owner's equity. So as you pay down your liabilities, guess what? Your owner's equity starts to go up, because if we have that dollar and our liabilities are at 50 cents and the owner's equity is 50 cents, what's going to happen is when you start to pay down those loan balances or start to pay off people, it's going to raise that owner's equity because those assets the company has starts to move basically over to the owner because we're paying off stuff. Now, you're never going to have no liabilities because you're going to always owe somebody something. You're going to either owe employees. Let's say you don't have any employees. Well, you're always going to owe taxes. So there's always going to be a liability on there for some kind of taxes of what it is. So the goal is, for most of you, if you go debt free and you try not to owe anybody, you might have, like, say, out of every dollar, 10 cents set aside for people that you owe money to, and the owner's equity is the 90 cents. But what's cool about this whole balance sheet is you can pull it up at any point in time and know exactly what your owner's equity is in your business. Now, keep in mind, the balance sheet changes day to day. So whatever you pull up today is not going to equal tomorrow, because remember those things that you're accruing on a regular basis. Now, it might not change by much if you look at this week versus next week, but you're going to have another week of payroll on there, another week of taxes that were collected, kind of a thing. Also, depending upon the net income in your business and how you're doing, that's going to have an impact. So when you run it every single month, think about it. If the business loses money, all right, then that means that the owner's equity goes down, because if your business has loses $5,000 that month, who do you think has to reach into their pocket to pay that $5,000? So what's going to happen is your owner's equity is going to drop that $5,000 from the net income line, and because it's going to pull it from money that is owed to you because you ended up having to pay that money. And therefore, it became a liability temporarily, so it lowered that owner's equity. But if your business starts to recuperate the very next month, guess what? Because you didn't pull an owner's draw, but basically what you did is you used your own money to pay for that. Now, I know some of this probably gets even more confusing as we're trying to do it here on the podcast. But like I said, there is a link in the show notes to actually see this visually. So that way you can watch it and see how it actually flows and what I'm talking about. My main purpose of today's episode was to touch on a topic that I have been talking about a lot recently. And you know, my theory is that when I have something come into my life that I'm doing multiple times, it means it's time for me to talk about it, because it's a signal out there that we need to. And for some reason, the balance sheet was coming up quite a bit. And I thought this was a perfect time to have this kind of dialogue. So just keep in mind, the balance sheet is a report that you get every single month from your accountant or your bookkeeper. Or if you do your books yourself, you can pull it up in your accounting software at any point in time. Your balance sheet is basically going to have three sections: your assets, your liabilities, and the owner's equity. And the reason that it balances is your assets will equal your liabilities and your owner's equity. Your owner's equity is basically your assets minus your liability. You can look at it a bunch of different ways, but if you keep in mind, if you have $1 in assets in your business and you owe 30 cents, you as the owner's equity is 70 cents in that business. And it will tell you at any given point in time that if you were to close the business down tomorrow, how much money you have and where that money would go, how you would pay off people and what you would be left with. Now, when people are selling their business, this is a great tool because it's going to tell you the bare minimum of what that business is worth. And then on top of that is the value that you're adding because of the ongoing business that you still have going on and the potential that you're transferring to somebody else. I'm not going to go into that. That's a subject for a different day. But the main thing that's cool about the balance sheet is it gives you a snapshot every single month with what the value of your business is. So here's what I want to challenge you to do. I want you to make sure that when you get your next packet from your bookkeeper or CPA or whoever does it for you, I want you to pull out that balance sheet and I want you to understand it. And if you happen to be in a place, go pull the last one that you got. Go look at it. If you do your own bookkeeping, go up there to reports, pull up balance sheet and bring it up. Look at it. And now it's going to get a little confusing because like I said, I'm trying to make it easy by giving you the basic categories. Sometimes it's going to be broken into a lot of little baby categories on there. Just know this is basically what the information is and don't get hung up on the way that it's laid out. There's easier way. That's just how it's keyed in. There's easier ways to get it keyed in to make more sense. And that's something you can do on your end if you do your books yourself, or you can even have your bookkeeper do that as well. It's just the way that they do the keying in of it into the actual system. But what you want to do is to basically understand what each of those numbers are. And hopefully this podcast episode has given you a much better idea of what a balance sheet is, why it's important for you to know it and understand it, and more importantly, has made you curious as to what yours is telling you, and you want to dive into it. And like I said, in the show notes is that video if you want to actually watch one broken down and visually go through this. All right, with that, I'm going to wrap this one up. Please, please, please know your business numbers. That's what we're here for. Is the best way for you to grow your business and become more profitable is to focus on those business numbers. Remember, it's not about your sales. Sales are great. Sales are a vanity number. Oh, I did $1 million. But at the end of the day, it's about the profit you put in your pocket and how you leverage your business. Because if you have $1 in assets and you owe 90 cents of every dollar in your liabilities and you've only got 10% in your owner's equity, that's not a profitable business. Okay? That's a business that's leveraged really bad. And I know some businesses that are like that, to where they just kept going in debt, and then they wonder why they don't have any money. And you pull up their balance sheet and there's no owner's equity because it's all up there in liabilities. So just remember, assets equals your liabilities and your owner's equity. That's why it balances those two numbers. Your owner's equity is your value in your business and what your business is worth today. Do not freak out if yours is terrible, because at least now you know, and now you know what you need to do. And that is one of the reasons we want you to be debt free. That's a whole nother topic for a different episode. But with that, I'm going to go ahead and wrap this puppy up because I'm sure I've already got your brain spinning around. So let's go ahead and end this, and I will talk to you on the next episode. Bye for now. Hey, badass business owner, before you go, as you know, I'm a huge believer in you knowing your business numbers. After all, it isn't about how much you sell, it's about what you keep. And the best way to grow your profits is to start diving in and understanding those business numbers. To help you on this journey, I have created the Know Your Business Numbers course. We will walk through how to read your profit and loss statement. You'll learn the key calculations that'll help ensure that you're making a healthy profit on all of your products or services. plus a ton of other good stuff that'll help you learn how to use those business numbers to create even more sales and profits. Just check out the link below in the show notes or visit knowyourbusinessnumberscourse.com. So if you're ready to increase those profits, it's time you start diving into your business numbers.